Every year, trillions of dollars in physical cargo cut across the open ocean. Behind these shipments is a massive transfer of capital moving across borders. But this movement is governed by a basic standoff. The exporter wants cash in hand before the goods leave the dock, while the importer wants to secure the goods before parting with a single cent. Add to that the geographic realities. Exporters face political instability, customer insolvency in transit, fluctuating currency values, and the inherent dangers of shipping across thousands of miles. This baseline lack of trust means that two companies operating an ocean apart cannot rely on a handshake. They require specialized banking mechanisms to bridge the gap. The entire discipline of international trade finance exists to solve this exact problem, finding a way to secure payments without freezing a company's cash flow or halting its supply chain. Every payment method in international trade is a negotiation between risk and control. On one extreme is prepayment, where the buyer pays cash in advance. It offers zero risk for the exporter, but requires the buyer to shoulder total liability before a single item ships. On the opposite extreme is the open account structure. Here, the goods are delivered before payment is due, giving the buyer a highly secure transaction, but completely exposing the exporter to non-payment. This chart plots standard international trade payment methods. Top down, we trace the exporter's risk ranking, moving from the safety of prepayment straight down to the high exposure of an open account. Positioned right here in the center are documentary collections. They act as the operational middle ground. When a seller refuses an open account and a buyer refuses to pay in advance, a documentary collection provides a highly structured compromise. The underlying mechanics of a documentary collection rely on a simple legal principle, separating the physical cargo from the documents that prove who owns it. In practice, the exporter loads the goods onto a ship immediately. However, they actively hold on to the legal title documents, effectively retaining ownership while the cargo is in transit. Instead of mailing those title documents directly to the buyer, the exporter routes them through the banking system. The exporter's remitting bank sends the paperwork to the buyer's collecting bank. The collecting bank receives strict instructions to hold those title documents hostage. They will not release them until specific financial conditions are met. If the buyer does not have the title documents, they cannot legally claim the goods at the destination port. This decoupling allows the exporter to initiate shipping immediately without giving up their final leverage. Because this process relies entirely on correspondent banks in different legal jurisdictions, the International Chamber of Commerce established a universal standard to define their responsibilities. That standard is the Uniform Rules for Collection, or URC 522. It is an internationally recognized rulebook adopted by nearly all banks worldwide. Under Article 2 of the URC 522, banks handle two strictly defined categories of documents during a collection. First are commercial documents. These include the invoices, transport documentation, and the critical documents of title that give whoever holds them the legal right to claim the cargo. Second are financial documents. These are the actual instruments used to demand payment, like promissory notes or, most commonly, a bill of exchange. If a bank processes financial documents entirely on their own, it is considered a clean collection.
But when those financial documents are explicitly attached to commercial title documents, it becomes a true documentary collection. Understanding these precise definitions is mandatory because a bank's procedures and legal liability are determined exactly by which documents they hold. Once a documentary collection is initiated, it typically follows one of two mechanical pathways. The first is documents against payment, widely known as a sight draft. In a sight draft transaction, the exporter's bank securely sends the document packet to the buyer's collecting bank. The buyer is required to pay cash the moment the documents arrive, literally upon sight. Only after the cash is secured will the bank release the title documents, allowing the buyer to claim the goods. Because the exporter retains legal title until the exact moment of payment, a sight draft provides a highly secure transaction framework. However, it carries a severe operational risk. If the buyer simply decides to walk away and refuses to pay the draft, the exporter's physical goods are now stranded at a foreign port. The exporter maintains ownership, but they are left holding the bill for expensive disposal or return freight. The second major pathway is documents against acceptance, or a time draft. Under a time draft, the buyer isn't required to pay up front. Instead, they sign a time draft, legally promising to pay at a future date. The moment the collecting bank receives the signature, an action known as acceptance, they immediately release the title documents. This signature shifts the timeline. The buyer takes legal and physical possession of the cargo long before any actual payment is transferred. For the exporter, the risk profile changes drastically. By accepting a time draft, they have surrendered control of the goods in exchange for a mere legal promise. Offering a time draft makes an exporter highly competitive by providing flexible credit to the buyer. But it leaves them completely exposed to total default when the maturity date arrives. A frequent and dangerous misconception among trade professionals is confusing a documentary collection with a documentary credit, better known as a letter of credit. While both methods utilize banks, their legal mechanics are distinct. In a letter of credit, the issuing bank guarantees payment. If documents comply, the bank pays. In a documentary collection, banks act as a secure mailroom transferring documents, but offer zero guarantee of payment. Furthermore, unlike letters of credit, the banks handling a collection explicitly do not verify the shipping documents for accuracy. Because this bank guarantee is absent, the ultimate financial risk of non-payment rests entirely on the shoulders of the exporter. So, without guarantees, when is a documentary collection the right tool to use? Internally, it should only be used when exporter and importer have an established relationship, and there is zero doubt regarding the buyer's willingness to pay. Externally, the political and economic conditions of the buyer's country must be completely stable, with no restrictive foreign exchange controls. If those criteria are met, the operational benefits are clear. Collections are vastly simpler, much faster, and significantly cheaper than processing letters of credit. Properly mapping the mechanics of URC 522 allows trade professionals to accurately calibrate their supply chain risk without choking their own operations in unnecessary costs.